What's up, everybody? How we doing? Yeah, thanks everyone for being here. Appreciate it. We'll get rolling here in a few minutes. I always like to get these posted early. Dude, I actually don't even know who Al Brooks is here, but they are always here. Shout out Al Brooks. Yeah, happenings. Welcome, welcome. Dude, isn't that thing annoying, that voice notification thing? But it's on uh sorry, it just saw something funny. It's on quant data. It's just like whales or whatever. And I hate it. It's so annoying. They just announced the most like random things that like aren't even big flow, like it just somehow meets their requirements, and they're just announcing the most random things all day. Did you hit those AMDs? Those ones work. But then I went digging and somebody hit like 200K in AMD calls into close. Oh, UAL. I heard him say that one. Oh, wow. Look at that. So you caught that from them talking? I don't even pull them up. But it's on quant data. I mean, it's just part of it. I don't know. It just talks. Um, and you heard me saying there's like different names for the alerts. I don't remember what they are right now. So if you were actually like looking into using something like that, you obviously want to learn more about it than I do. I really just have it up to look for any like, large flow that seems cool to me. But like it was given like, I don't know, these crazy, like I just pulled it up just to look. One of them was iTub. I don't know what this is. ITAU. I don't know. Looks like it's a South American bank, apparently. Oh yeah, there's those UAL 4550 calls. Those were good. But yeah, I don't know. I see there was some Netflix calls, ABBV or ABBV all day. That one's weird. I don't know why they'd be getting into that, but they were hitting calls on that one pretty heavy for some reason. I couldn't tell you why. Doesn't look like it worked super well. But yeah, I mean, some of them with the ones that like when they say a big name, and this is, we'll get going here in just a second. We're just talking a little bit about quant data. When they say a big name, like there actually was one that I heard, there wasn't a lot of them that came through. But this one, let's see. They had Netflix coming through at 10:20. So somewhere right around here, they had some Netflix calls coming in on that thing. So that would have been a nice little one. So I'll normally pull those up and look at it. But the issue is that a lot of the time I've noticed that you'll get one of those alerts and it's really just like breaking a high. But it hasn't really confirmed anything. So you always want to be a little bit careful taking those kinds of things. And then on the other side, I mean, today, let's see, I can even look. I mean, they were hammering Tesla long today. I saw a big one come in at 8. Let's see, somewhere right around here. So 6, 7, yes, 7 o'clock my time. Sorry, I'm West Coast. 7 o'clock my time. They were hammering Tesla calls. Or at least, I mean, not hammering, but 1.5 million of them. Or $1.5 million worth, and they got clobbered today. So you always want to look at the charts and kind of decide what it's going to do. Tesla to 197, that'd be funny. I mean, I know that I would not be short on Tesla. Like, I mean, it filled the gap and it bounced it almost perfectly today. I mean, the dip buy on Tesla was a great one today. The dip buy on Tesla yesterday also made a ton of sense, but got clobbered by the gap down. That's all it was. But we've now filled this gap here. So, there, in my opinion, there's no reason to be too short on Tesla until we give up that 225 area, at least in my opinion. I would not be looking short on it just yet myself. That's what they're 237. I love it. That's awesome. Yeah, who knows? I mean, who knows, what it's gonna do. That's why I don't like trading Tesla. Like, there's no reason to expect some big old gap down on that thing that then just sold heavy all day, they're not all day, but for a good part of the day. So that's why I don't love Tesla. I especially don't love the Tesla swing. We'll get going here in just 1 second. How's everybody doing? How's everybody's trading day today? Hopefully it was a fun one. Okay, and with that, we are going to get started. Thank you everybody for coming, Dirty River. Happy to have you. Tonight we are going to be talking EMAs and SMAs. And we're going to kind of start with just some of them that I like to, we're just going to talk about the ones that I like to use. You'll probably hear me repeat this a lot throughout the lecture tonight. There's a million different ways that you can do EMAs, a million different combos. You can literally type in whatever number you want. And there's how you space those numbers is what will kind of, it will tell you how quickly you'll get crossovers, things like that. But and we'll kind of get into some of the risks of doing it that way. But we're gonna just talk about mostly my favorite EMA and SMA combos, ones that I've used for a long time, and just something that I think everybody should take advantage of. They are a lagging indicator. All indicators are lagging, so they aren't printing right away. And especially we're going to talk about the SMAs today, or we're going to start with the SMAs today, and they are one that I like to use them on longer time frames. I was actually DMing with somebody today, and they were having success with the 200 SMA on short time frames, using it on the 5 or 15 minute or whatever. And they can be a super powerful tool on those shorter time frames as well, just because they lack the they don't take as much volatility into account as something like an EMA does. Then I prefer an EMA on the shorter time frames because it's a little bit more reactive. The SMAs are a much smoother thing. Yeah, good question. I should probably say that. So an SMA, it's a simple moving average. And they're simple, they're very simple. So the number that you're associating it with is telling you how many, candles, days, whatever you're looking back over. So, let's just pull up a chart and look at it. We'll do SPY, we'll go intraday. And so you hear a lot of us talk about, we're just going to go for the 9 EMA on here. And then we are going to also add a simple moving average. And so a simple moving average, oops, definitely not that. A simple moving average, very, very simple calculation. And so let's see, I'm going to make these very different colors. We'll make the SMA is going to be green. So you can see they kind of move the same, but a simple moving average is going to be smoother. You see how the green line kind of is a much smoother run. The purple pink line is a bit more, choppy. And so what this pink line is the 9 EMA. And so when we discuss those numbers, it doesn't matter simple moving average or EMA, which is exponential moving average, thus the volatility going into the calculation. The number is telling you how many candles back is it calculating. So it doesn't matter, if you're on the daily, it's going to be 9 daily candles. If you're on the 5 minute, it's going to be 9 5-minute candles. So what this price is on the EMA is actually calculated from the closes of all of these candles. So we aren't going to go into the math of an EMA tonight because it's super advanced. We don't need to do it. The math on the SMA, and thus why it's a bit slower and, more gradual, is very, very simple. You take the price of the candle close and the candle close and add them together and then divide by how many there are. And that will give you the price that the simple moving average will be at. So very, very simple calculation. EMA is much more difficult calculation. We aren't even going to get into it today. But basically, the main difference that we need to know is an EMA is going to be much more reactive. An SMA is going to be a much more, slow, gradual sort of movement, as opposed to something like an EMA that's typically going to be, a bit choppier, have the bounces around, just because in its math, an EMA puts, if we were looking at a 9 EMA, say on these candles, it is calculating based on these candles, but it's putting more weight onto the recent candles than the beginning candles, so 9 candles back has the least weight, 1 candle back has the most weight. So that's why you get these very dramatic reactions out of it, versus something like an SMA. You can see we've already broken down, this thing is kinking down while the SMA is basically just going sideways. And so that's the only difference between them. One is more reactive, one is less reactive. Can we explain VWAP? Not today. What's up on K? How you doing? Why is my hourly 20 EMA always wonky and not smooth? Because, and for anybody who wants to know, we'll just pull it up real quick, because it's always wonky and not smooth. But only when you are seeing it on the 5-minute chart. And so that's what a lot of people don't realize. I am posting this on the 5-minute chart, so it has these stair steps to it. And the reason that is because each of these stair steps is an hour's time. So it does the calculation here and it adjusts. And so then it goes another hour's time and then it recalculates here, and it goes another hour's time. So it's always going to be choppy like that. But then if you go to like the hourly, if you go to the hourly, it's smooth. So, but I like to be able to look at it because in my opinion, it's typically going to be one of the more crucial levels on the chart. And so I always like to have it up. That's something I actually picked up from Al Brooks. He runs the hourly 20 all the time. That's, I think, the only indicator he really uses. And so the hourly 20 EMA, just a really, really powerful tool. And it's something that I like to recommend it to people to have a bias, not be super biased, but if you are above it, you should be looking to buy dips. If you are below it, you should be looking to short rips. I mean, that's an extreme generalization, but typically any break of it is going to be either met with buying or consolidation. I mean, you're going to you can see big selling below it. Obviously, this is not selling because the 20 broke, you know, but you can see big selling below it, or you can see a nice pop that leads into consolidation while the market decides what it's going to do. Because this is basically, you know, this is the price that, this isn't 100% accurate, but this is the price that over the last, you know, 20 hours of trading, the bulls are winning or the bears are winning, you know, in simplest terms. And so it's something that we're actually going to get into this later. So we'll come back to it. But with that, now we are going to start into the real lecture. As always, you know, for me, I always like to start on the daily. And we'll get that. Well, no, we'll leave 475 on there. This must have been for me talking previously saying, watch this level. So we're going to start with the SMAs. And again, these are the simple moving averages. The ones that I like to use, and it's not just me, it's most everybody pays attention to these. You can, of course, use some of the intermediate ones, but the ones that I like are the 20, the 50, and the 200. And so the 20 SMA is giving you a pretty nice idea of, you know, where we've been over the last month, you know, 20 trading days, basically 4 weeks of trading. 50, then the 50 tells us a bit, you know, quite a bit more on the daily. You know, you're getting out there for 2.5 months, you know, if you bought shares in the last 2.5 months, you're basically green on SPY. And then 200 day, as we all know, huge level. Market rarely likes to spend much time below it. If it does spend time below it, there's 99% chance there's other, you know, economic or world situations going on that are keeping it down there. And so those are the main ones I use. Again, just to repeat, the 20 day, the 50 day, and the 200. They're the most common ones people use. They tend to be very, very reactive, and you can see they're very gradual. So, you know, a crossing of a daily SMA, rarely something that's going to give you a huge breakout. I don't want to say that, you know, that it never will. But the crossing of an SMA is just so delayed that we can even see it. And I know that this is an exceptional run on SPY that we've been on, but you can see here, SPY had run, I mean, $30, even more, $40 by the time the SMAs finally caught up and made that cross to be bullish. So these aren't going to be, you know, like, you know, you wait for a cross and you catch some huge move. Every once in a while, of course you will, but a lot of the time, by the time the cross comes, you're getting ready to consolidate for a while, as we saw previously. However, how I like to take note of them is looking at them on these major time frames. And if we are trading around them, I will base trades around those levels all day long. You know, they make it very, very simple. And so unfortunately, I think, yeah. So going into the day, that 20 daily SMA was at that 472.26. And so it was something that, you know, I was personally watching. I was definitely posting about it in my tab over and over again, as a big level to watch. And so, so I'll put this, I'll name this so we can see it. So a big level to watch, because the market, especially when you're, you know, in bullish territory or bearish territory, it doesn't matter. The market, if you are trending up, it doesn't like to spend time below the SMAs. You can see, you know, we got this breakdown last week for a second, but buyers weren't letting us they weren't letting us really die here. They were trying to hold on to this, of course, waiting for data this week or whatever they were doing. And then once we broke the upside, you know, we had that big move on Monday. Going into Tuesday, very, very easy to stay bullish above that 20 day. And so you can know that as we're getting into those levels, it's typically going to be a good dip buy on that level. And if it's not, as all of you know, I like to trade with super tight stops. And so something like a 20-day moving average is going to make it really, really easy to say, I'm buying calls here, letting it breathe for a second and waiting to see if we can get a move off of that level. And so, you know, we marked this 20-day here. And then as we went into day, it was the bottom. I mean, I think maybe this is off a little bit. I just read what it previously said. This might be off by a few cents, but they sold us to the 20-day, and within cents of the bottom is where that 20-day was. So it was, once again, when we go back to the daily and we're analyzing these SMAs, we can say, we buy all dips down to the 20. I mean, even if it's, if it's at the bottom of a $6 sell-off, that's where we start looking to get long with stops below it. It makes it very, very simple. And so worked the same on Tuesday. We were obviously way away from it on Wednesday, made it, pretty easy to stay bullish when we were pushing up like that. And then today, obviously marked basically the bottom. So that's going to be it for that. All we're going to talk about on the SMAs. Long time frames is my main focus on them. They do a very good job at showing overall trend of the market and how the market is trending and things to look for. But the only other place that I really, really like to look at them, and places where they will become, absolutely crucial in the long run, is on the weekly time frames. If you ever find yourself trading around any of the weekly SMAs, and this is on any stock, we're just talking SPY today, but on any stock, you want to trade those levels and treat those levels as, assuming they won't break. And if they do break, you'll see a nice move through it. But always treating them as not breaking. I mean, one of the really good ones that we just had recently, and this is actually on the daily on Apple, the 200-day. It was one of the easier dip buys we've been presented. You get long, and we talked about this last week. If we come down to that 200-day, you get long with a stop below it. And as you can see, if you waited basically until that 200-day hit, you would have sniped the absolute bottom and been up $5 on Apple in a few days, And so, very, very important levels, in my opinion, is going to be all of those daily SMAs. So next thing we're going to talk about, I'll see if I have any questions. Yeah, the hourly 20 is insane. It's one of my favorites, for sure. Just a very effective thing to put on your charts if you like it. Do I only use the SMAs on higher time frames? I won't say I only use them. As I talked, in here, the 200-day. I mean, if you're on the 5-minute chart, that is telling you the average based on the last 200 5-minute candles. So it's plenty of time. Will likely act as a very important level. And somebody's messaging me today. I think they were actually trading Apple. Oh yeah, and he told me they hit it short on the retest of the 200 break, is what they said. And so they can be very, very good intraday as well. I've just always used EMAs, so it's what I like to use. And so with that, the next ones that we're going to get into are obviously going to be some EMAs, and we're going to start with the shorter time frame. Well, and you can use them on all time frames, obviously, but we're going to start with the ones I mostly look at on shorter time frames, and then get to the longer time frame ones, things to identify trends on like the hourly and stuff like that. Ones that I like to look for crosses on, basically in direct correlation to swing trades. And so first one that we're going to start off with, and I use Thinkorswim, so you can just save them all, is going to be the 9, the 20, and the 50. Some people will use the 21. You will notice basically little to no difference between the 20 and the 21. If I'm entirely honest, at one point I typed in the 20 and I've never changed it. And so, not because I liked it or anything, just because I didn't realize you can even see my study set is saved as 9, 21, 50, but it is in fact the 9, 20, and 50. It's just what I've used forever now. And so when we're talking about these are, absolutely some of the most popular ones for day trading, any sort of scalping. They do a really, really great job at, identifying places where you will likely get continuation in a trend. That's the main way that, people like me, Mad Flips in the house. Hey, I was scrolling down. There you are. Hope you're doing good, Flips. So anybody like me or Flips or anybody that uses these things, they're just a really, really wonderful tool to trade off of. And I typically like to look for them for continuation. They can do good things, when you get the 9 crossing back over the 20 or the 50 or whatever, they can be a good indicator like that. But how I and most other people like to trade them is going to be any sort of break through them and then consolidation back into it. And so, some people call them flags, some people call them whatever it is, but the best way, in my opinion, is to think about anytime you get a volatile move, especially the first one, if you're looking at a volatile move in the market and you're breaking below the EMAs, for me, and most people who scalp, I'm never, I'm not going to get short right here. If you're short here for whatever reason, right at the 9, which I obviously don't recommend, and you catch this move down, then great. But you don't ever want to short this candle. What I like to look for anytime you get a bit of an exaggerated move away from an EMA, we really get a big gap between the candle and the EMA. You want to do, some people call it let the EMAs catch up, whatever it is, but you want to let the market consolidate for a second. And when something's consolidating, that's what people might call a flag, or anything like that. I like to just think of it as market consolidation to kind of, fix that EMA like discrepancy that we have here. So you always want to wait for the market to consolidate, and then you want to try to get in on these EMA touches. This one looks like it would have worked very well, but as we said, because it's a lagging indicator, this was likely up here somewhere until the candle closed way down here, really pushing it down. But you don't want to get short here. You really don't want to get short here. You really don't want to get short here. But as you come back into this 9 EMA, this is where they become valuable. So you want to enter wherever it is, somewhere over here. And then if you were using another EMA, say a 20 EMA or anything like that, you can use that as your stop loss. So if you break out here, then you can just have your stop somewhere up here. So when you wait for these consolidations back into the 9 EMA, you really get to reduce your risk on the trade. Whereas somebody who enters the same day here, if it ends up bouncing all the way to up here, they're going to be losing more money than this person losing just that quick little bounce. So you always want to, this is the most common way to trade an EMA. And then, always just shorting those pullbacks into it, and understanding that your stop is going to be really any strong close above them, and so the other way that I really like to use EMAs, and I'm not seeing a perfect one. This is, I think, one that we might have hit today. Another way that I'll like to use EMAs is, and we only have a couple levels on the chart. Obviously, my chart would have a few more levels than this, but is using them for just technical bounces. It's something that you can do pretty repeatably, not for very big gains typically, but for nice, very quick scalps, just looking for the volatile bounce. That's when a contract is going to pay you the most, when you can get those 30, 40, 50% trades on SPY in one candle, is a lot of the time going to be the bounce back towards the EMA. And so this was one that I talked about today, I believe, in my tab, just saying trade around that hourly 20, wherever it was. I'm sure we're a little low. I should probably, because I think it broke just barely below it, if I remember. So we'll just call it there. I said, look to play this hourly 20 bounce up to the 9. And so it's not a huge move, but it's a 60-cent move that happens very, very quickly. And so knowing that our stop is right below here. So you might hear me or Flips or anybody that, trades or scalps a lot say we're looking for a bounce. That doesn't always mean, we're looking for a market reversal. That can mean we're looking for a bounce up to the EMA. If we break it, great, but it is worth taking that little bit of risk just to try to catch the move back to the EMA. So that's another really, really great way to use them. And then the other, in my opinion, really great purpose that specifically the 9 and the 20 show us is for people that and I know this might sound weird, but it's very common for people. For people that have trouble identifying if we're in a trend or not, the 9 EMA is a little bit too volatile to really say, but this orange line is the 20 EMA. And it's something that, and this is a generalization, but if it's pointed down and to the right, we are trending down. If it's pointed up and to the right, we are trending up. So you can kind of, if you have the 9 and the 20 and they're both pointed in the same direction, you can start to pretty comfortably short most bounces until it doesn't work. And so things that you always want to watch for in EMAs is we had a, very obviously strong downtrend going into the day. Well, a couple hours into the day, all of a sudden these EMAs started going sideways. They absolutely can break back down, of course, but you want to use your EMAs to kind of give you an idea of what the market is doing statistically. And so because, these are being calculated every single candle, we can look at these and say, hey, market is trending down. Well, now they're all going sideways. Market is no longer trending down. We aren't trying to say that it will, immediately turn around and run. And we aren't trying to say that it can't break down and keep going down more. But when you start to see these EMAs go sideways, start to, ease off on your trades. We're likely at the very least going into consolidation. And then if we do consolidate, you can just kind of look at whatever range is made doing this consolidation. EMAs going sideways. All of a sudden you have EMAs starting to cross after a little breakout. Now you can start to say, okay, EMAs pointed up, 9 and 20 are pointed up. I can start to look to buy pullbacks on this thing and try to catch bounces. And then the 50 is the one that you really can't argue with. If you're below the 50, trend is down. You really shouldn't be looking to scalp too many bounces. If you're above the 50, trend is likely up. And so you need to be looking to, buy the dips and short the rips, short it sort of thing, as opposed to the other way on the way down. And so, that's how I personally use the 920 50. I think it's basically how everybody uses the 920 and 50. And then one thing where they can get really, really tricky. Let's see if we have one recently. We really don't. This one. When the EMAs are all tight together and the market's really, really going sideways, they are not a lot of help. So always be, and I'll see if I can find an even better one. Always be cautious of trading EMAs on chop days. Because when they're mostly just going sideways, here's one. People are getting smoked on days like this. While it does provide some good scalps, anybody that's looking to play these EMA like bounces or crossovers is typically being left pretty disappointed because, you might catch a nice candle down or up, but when we're chopping, the EMAs make it very, very apparent that we are chopping. And so it's a great way to, say, hey, if I don't like trading, scalping and chop, maybe I won't trade if all the EMAs are pointed sideways. I'll wait for that consolidation to break and then take the trades. Because those choppy days are the ones where everybody seems to just get clobbered. Let's see. Yeah, 9 can be a great one for, break above it, pull back to it and buy pullbacks. Break and retest, really classic way to trade it. And that's, if you're playing those, if you're trying to catch a reversal, way easier to just play the bounces into it and continue with the trend. But if you get the 9 EMA break and pull back into it with some buyers showing up or sellers showing up, it's a great, great one to trade. So next one I'm going to talk about, much older, this is one of the old timer EMA classics. And it's mostly made for, I don't want to say scalping, but for the idea of this combo right here, is catching reversals in the market early. It does absolutely provide fake outs as many EMAs can, but it also does a very, very good job at providing, very effective trades when when the cross happens, you will typically get volatile movement shortly after the cross happens. Of course, when you are trading in a uh of course, when you are trading in a choppy market, it's going to be loaded with reversals. I actually had a friend kind of do something for me, and so he made just a thing that, it tells you when the cross happens. It's in no way, shape, or form a buy signal. You can see right here, if you short it, you got clobbered instantly. But we're going to turn it on today just because we can easily see it. And so what this combo is the 5 and the 13. And so when I was talking earlier about, you can set the numbers to whatever you want, it's up to you. You can find something that works well for you. And the 513 is super old one. A lot of people use the 8 and 13 now, even the 9 and 13 now. I like the 5 and 13 because you have a volatile one, the 5 EMA. It's only looking back 5 candles, so it's picking up volatility quickly. And then you have the 13, which is still definitely on the shorter end of EMA lengths that it'll go back and look. However, it does a very good job at catching these reversals when they happen. And because the 5 EMA is so volatile, this purple one doesn't look very purple right now, but this purple one, because it is so volatile, it happens fast. The cross happens quick if it's going to. It unfortunately can give you fake outs like this or fake outs like this because of it. But I like to use it and say, okay, we have a cross, and it is my favorite short time frame EMA combo to trade across. And what we mean by across is, the 5 is dropping below the 13. That's it. That's all we're trying to do here is look for the 5 below the 13 or the 5 above the 13. Doesn't matter exactly what it is. But you just want to trade those crosses when they come. And they provide you a very, very nice stop out. Of course, this is one where, the cross happened quickly. So the best we can do is look for a short and a pullback into it. And that is the only other way that I really like, or, long, of course, but that is really the only other way I like to use this one. But how I use this one is I really want it to pull to the 13. It's really got my colors messed up. I don't know if they're messed up for you guys right now, but we're going to make these a bit more discernible. Give me just 1 second. We'll make the we're gonna make that 5 EMA just well, it's not liking it. This hideous yellow right here is the 5 EMA. So 5 EMA below. I'm going to look for it to pull to the 13 if I want to buy it. Or short it or whatever it is, because you might get like the 5 is just a little too, I don't trust it to be support or resistance as much as I would a 9 EMA or, or the 13, obviously. So I'm always going to look for pulls into the 13, knowing my stop is just to close outside of them. And typically, if you aren't getting across, you aren't going to get blown out of the water. So you can see today was a day where buying the, oh yeah, whoever said that, you're super smart. Okay, thank you. I was running them both. So here we are. We're back again. 5 blue, 13 pink. So you buy them back into here, short it, or buy your puts into here, short it. Again, buy them here, short it. Stops are, any close above here. Great for these types of volatile movements. And then anytime you get across, I like to look and see, something that I'll do frequently is I watch SPY, QQQ, and IWM. And if you are getting, all of a sudden you're getting bullish crosses on all of them at the same time or something like that, just as an example, or bearish crosses, you can start to say, oh, we might see a good pop in the market. We have the 3 major ETFs, going into a buy mode sort of situation. And so that's how I like to use them. Just a simple crossover, or just like a 9 and 20, whatever you like to use, a pullback into them to short them. I just feel that the 5 and 13 is, one of them, it is in my opinion, the most superior EMA combo for playing any sort of crossover. It's how you can catch those, really, really volatile moves faster than other people will make it. And so for me, these arrows do print mid candle, but that also means they can disappear mid candle if it ends up not crossing. So I do still always wait for a bit of confirmation or even a cross and a pullback into it. But can be a really, really great one. Yeah, most people don't trade it anymore. It's like old guys, they really like that one. It was one of the first ones that was being used. And it was being used in the same way. And you don't have to limit yourself to the 5 minute. The 15-minute one can provide really great crosses as well. But as you can see, because of what, you know, um, when you get to these longer time frames, the crosses happen so much later because 5 minute candles, you're only 25 minutes back is all you're looking. On 30-minute candles, all of a sudden you're looking 2.5 hours back for this thing to move. So it's just not the ideal one to use on, many of the longer time frames. If you do see a 513 cross on something like the 15 or 30-minute, it can do really well. But on on that 5 minute chart, even the 10-minute chart, it can be okay. But on the 5 minute chart, it tends to uh, really give you some volatile reactions. And if you don't get a volatile reaction, then you get a stop out for a small loss, which is, likely pretty important. Yeah. And so something that, yeah, what you're saying there, Justin, is exactly right. If you can't just like trade this, I'm merely discussing how I trade these. If we, let's see. So if I'm looking at something like this and I'm seeing a 530, this is my actual chart that I was trading today, So if I see a cross like this, I am looking to short any bounce and this trend, hadn't necessarily formed yet. But I'm looking to short any bounce because we have given up a level. We are going to be closer to my level down here, but my stop is going to be cents above. We're seeing strong selling, obviously increasing seller volume. It gives you plenty of reason to be looking to get in short on this bounce down here, or a little pullback right here. So always, anything you do, you need to be taking levels, taking those kinds of things into account. But today we're merely talking about just the simple what you're looking for on your EMAs, and now you couple that up with whatever you trade with now, support, resistance, trends, whatever you use. I think most people can benefit from it. But like I said, for me, I think this one just does a really, really great job at identifying, potential reversals in the market. Obviously, you can get faked out if the market's choppy, but just kind of look at the EMAs. Are they just going sideways for candles? Then assume you're getting some fake outs here. That's all you got to do. Okay, and so with that, if nobody's got any other questions on those, we will go on. Next one we're going to talk about. Do I prefer 9, 20, 50 EMA? I like those on the shorter time frames. Those are my most commonly used ones, but I also have these on a chart, the 5 and 13, all day, every day. I think that, they are a really, really powerful tool. You can pull it up on all kinds of things. It'll do a great job. This one was sweet, it'll do a very, very great job at catching those crosses. It's not, you can get blown out of the water just like anything else, but it can also really tell you when something is going to happen. Obviously works well. I'm just pulling up random charts right now, but works well on everything, so I have a chart with the 5 and the 13 always up, 9, 20, 50 on every chart that I look at. But I also dedicate a square to watching, well, these and Bollinger Bands together they're wild. Oh yeah, Pro Dreamer answered that. Do I bring it up all the time? Yep, exactly, Josh. Just using them with any of your levels. And that's what I talk about. We even saw it on my chart. I gotta spell it real quick. let me just talk about it. On my chart today, at one point, I was saying, I think it was like right here, and we were bouncing up to, I think we had like the 9, the trend, and this 475 level right here. And that's what I said. Watch for the break, but this thing could really, or this could really get smacked down because you have, at that point you have an EMA, you have a trend, and you have a level all working against you. So it all comes down to using all of those things. But you know, they're a very simple tool everybody should use. Okay, so next one we're going to talk, and this is one that I think is great for some of those slightly longer time frames. It can be a really good one to um, you know, for the day traders, those kinds of people, because they're longer time frame, they're going back and they're looking at longer things. You can start to look at these on, the 15-minute. And because we have these longer time frame ones, and you're trying to be a day trader, and hold your trades for longer, not just scalp. I love this combo. And what this one is going to be, we had a weird day today, obviously, with the big sell-off. What this one is the 12 and the 50 EMA. Again, not SMA, 12 and 50 EMA. And it's one that on some of these longer time frames, 15-minute, 30-minute, hourly, look for those crosses. That's mostly, again, how I use this one is I like to look for the cross and see, I don't want to say predict the cross, but when you have, when you're watching these longer time frames, most people spend so much time on the 5-minute, they forget that they forget that these longer time frames, like everything's much more gradual. You can start to see them coming. We had a bunch of sideways EMAs, and then we finally have one start kinking up. You can start to look for these trades to ride them to the next EMA and then use them as your stop outs. And so and then they do a very good job. If you zoom out, as me and 1K and everybody else tell people to do, they do a really good job at telling you where's the trend at. If you are a swing trader, if you're trying to do some of those longer trades, I highly recommend looking at some of these longer time frame ones. As I said, this is a really great one for intraday stuff. 15-minute, holding those day trades longer, those kinds of things. Just saying, like yesterday would have been a great one. My stops are just simply below this 12 EMA. I'm long, trends pointed up, we've crossed to the upside. I'm long as long as we're holding above this thing. Obviously yesterday wasn't, you got a nice couple buck move on it. But it offered that, slower pace trade, not scalping, letting candles close and really seeing, what you can get. Obviously, as I talked about, when you get these big discrepancies where you've really pulled away from the EMAs, that's typically where you want to really start considering taking a good amount of your profit, because just statistically speaking, we'll pull back to them. We will, and so I love to look at these ones. Great for those day traders on the days where we really are just ripping, they can get a little bit blown out. So you do want to be conscious of that. But a really, really great tool, people, the number one question we always get, how do I hold longer? And one of the easiest ways to do it, go look at a longer time frame and slap up an EMA and see what it is doing. And so really, really great for day traders. Obviously would have just caught your ripper on Monday if you happen to be in it. But just a really, really great tool for them. Let's see. Do I use RSI? No, couldn't pay me to put RSI on my chart, if I'm entirely honest with you. Okay, and so very last combo we're going to cover tonight. Well, last combo, and then we're going to touch on just my favorite. If I had to pick one, which one would it be? We're going to talk about that. But this very last one that we're going to talk is another one. This is longer time frames. Let's see if this is going to work for me. So this is longer time frame one specifically. I like to use this, look at this on the hourly, look at this on the 4-hour, those kinds of things. This is for, my favorite one for thinking about swing trades, or thinking, is it time to take profit, any of that stuff. This is my favorite combo for longer time frame crossovers as well as trend identification. And so the combo is the 1334. So just a little bit different than the last one that was 12 and 50. Obviously you could probably do 12 and 34 if you want, but 13 and 34, I like the 13 because you're basically getting about 2.5 weeks of data in it, and then 34 is giving you, you know, a month and 3/4 worth of data. So you have a really good idea of strong trends developing, and things that you can look for. You know, do I want to swing these kinds of things? Are we getting crossovers? Are we looking at, you know, something like we had here where we're getting frequent crosses? You know, for the people who don't like range trading, looking at the 1334 on things like the hourly, the 4 hour, those kinds of things, they can tell you, hey, don't trade today. The market is choppy. So let the market break this range and then start to look for trades to take. And as you can see, as long as the market isn't ranging, which is, as we've said a million times tonight, a terrible time to try to trade with EMAs. If the market is not ranging, you can likely get some very, very nice trades off of the hourly using this 13 and 34 combo. Obviously, you know, when you get something like this, you want to start to look to short all bounces up towards it. Stops are going to be above it. One thing to note, if you're trading these longer time frame EMAs, they are typically going to have, until crosses and things like that occur, they're typically going to have a bit more spread between them. And so the double-edged sword of that is your stop is wider. So you're instantly putting on more risk if you're going to try to trade these types of crossovers. However, that's what swing traders need to be prepared for. You know, as a scalper or just even intraday faster trades, we need to limit our loss as much as we can. Swing traders, the safest way to swing trade is size down and widen your stop. You know, I'm not saying hold to zero or anything like that, but you need to understand that in swing trades, you can end up losing a whole lot more than you're ever going to lose scalping. And so you need to prepare for that. And so that's something whenever I'm talking about these longer time frame EMAs, be, you know, aware of that. If you're shorting the 13 and your stop is above, you know, the 34, there's going to be times where your stop is going to be a buck or two above you on SPY, which even if your contract's got a week's time, that can put a hurting on it, you know. And then understanding if you are writing a trend, you know, something we had obviously very nice trend going around through here, you know, had this very nice trend going on. Well, we get a trend break and we get that big EMA cross. Now you need to stop fighting the trend and say to yourself, you know, it's time to start looking long, time to start looking to buy these pullbacks. Obviously today we had a big breakdown, but when we're above these, you're looking to buy all pullbacks to them. Of course, the crosses can provide really nice swing trades, or even just intraday trades, whatever it is. Or if we're in a choppy market, they can blow you out, you know, something that you don't really want to do. And so this is just another one of those combos, 1334, longer time frames, hourly, 4 hour, any of those kinds of crosses. You know, you can, if you're getting some big crosses on it, you can start to find some really, really nice moves out. And, you know, these will work on anything, all, you know, all stocks and everything. But some of these bigger ones, they do a very, very good job at, you know, either telling you, hey, market's consolidating, you're getting chopped up, or we're breaking down, ride it, you know, or we're bouncing, ride it up, you know. Doesn't matter what it is. But if you're into swing trading and you aren't taking, you know, these EMAs into consideration, I think you're really doing yourself a disservice. Let's see. Oh yeah, RSI. Well, no, your stop loss does not hit. It does not hit it, because, you know, if it opens below the price that your stop loss is at, nobody's going to pay you that much money for it. You know, nobody wants to buy it for more than it's worth. So stop loss doesn't really, you know, once you've swung, you're in it for the long haul. And you know, you can have those kinds of things happen, like, you know, maybe you shorted because we came back up into this trend. Very, very reasonable thing. You got blown out of the water the next day. You know, you got to be careful swinging over weekends, of course, but you know, so stop losses are great, but they only work when the market is working. And so final one that I'm going to talk about tonight, and we're going to do it. I'm going to have, let's see, so the last one that I'm going to talk about, and I'm going to talk about it how I use it. And so I have this pinned in my tab. This is just a study. And it obviously is very important on the hourly chart. So you can, of course, just look at it on the hourly chart. And 1K asked this question earlier. I don't know if he's still in here. People have noticed in some of my charts, sometimes I post the chart that has it. This is the hourly 20 EMA. And so why it looks stair-steppy, like this, why it makes these drops is because it only recalculates once an hour. So it only changes, the hourly EMA only changes once an hour. And so that is the data points that we are seeing here on that hourly 20 EMA. And it's like if I had to pick one thing to trade with, like one EMA, and that was all I got to use, I am almost guaranteed going for the hourly 20. It's just something that, provides you trades almost every day. It does a very good job at identifying trends. It has very volatile reactions when broken, or even when it just goes from, going up to down. Those kinds of moves on the hourly 20 can provide a very, very nice move. And so for me, that hourly 20 EMA is really just one of the most crucial ones you can use. And so I get asked a lot, about how do you build a bias going into the day. And I don't want to say build a bias so much, but because you should never be biased in trading. Who cares if the market goes up or down? Like, we're buying contracts and that we never had the plan of fulfilling, and so we just sell them at the end of the day or whenever it is. So we don't plan to fulfill the contract. I'm not going to buy the shares. I don't care about the shares. I want to buy a contract for cheap and I want to sell it for more. That's all we care about. So we should not care if the market is going up or down. It doesn't matter if you're bearish or bullish or whatever it is. But the hourly 20 lets us know, if we're below it, you should likely be trying to be short. Obviously, like, things like this can happen where we get the big reversion to it, but the people that were trying to short this whole run were just being greedy. They got the $6 drop or whatever it was, and they just kept thinking it's going to go more, it's going to go more, it's going to go more. And that's kind of what the market does. They just start blowing out those shorts, and it can work this way. There are people that thought every dip was a buy, and those people were so wrong, and they got smoked today. And they were screaming buy the dip all morning, and then blew up their ports probably by the time the market bounced finally. So how I use the 20, if we're below it, I'm looking to short bounces. And then on the other side of it, if we are breaking above it, I'm likely buying dips down towards it. It's just a very, very great way to, have just a line in the sand. A lot of people struggle with trend. They hold trades too long, and if you are buying calls and we're breaking below the hourly 20, you likely want to exit those calls. If you're buying puts and we're breaking above the hourly 20, you likely want to exit those puts, because that means everybody in the last day is now making money on their shares. And so, it can be a great, great tool. I was looking for a day where it had some fake outs, obviously consolidating market. We were in, got a $1.50 range this day. So it's just basically going sideways. You want to be hitting it on those days where we're above it and it is stair stepping up all day long, something like that. Obviously, that was an insane day, but this kind of thing, some nice steps up, pulls back to it, a bunch of dips to buy all the way down to it. So this is, for me, if I had to choose one, it's going to be the hourly 20. And as I said, this is showing it on the 5-minute chart. If we go to the hourly, looks much smoother, but I really like to look on the 5-minute, even the 15-minute chart, just to say, where are we trading in relation to this thing? And so with that, that's all I got. We got a couple minutes left, so if anybody has questions, feel free to ask them. And if not, thank you everybody for coming. Really appreciate you being here. Love talking EMAs. You're gonna short Tesla tomorrow, huh? If it breaks that thing down, then yeah. So somebody asking here, Rodrigo asking me about, so I gotta be honest with you. I don't trade patterns. They're just wrong all the time, you know? And so I tend to avoid trading any named pattern. It kind of goes back to that bias thing. You know, I've seen too many bull flags break down and bear flags break up. And, you know, I've just seen patterns be wrong too much for me to put much faith in them. But I am not seeing, I mean, maybe you were talking about this, but it is long gone if that is what you were talking about. But I still wouldn't even call that a Head and Shoulders. If I'm gonna look for a Head and Shoulders, I'm gonna be a stickler. The neckline needs to be the neckline. You need to have a shoulder. You need to have a head that goes lower than the shoulder, and you need to have a shoulder that basically comes back to the exact same level. If it doesn't meet those specific parameters, I don't trade it. I also know people sometimes try to do them like wall that's trending up. You know, Head and Shoulders come at the bottom of trends or the tops of trends. And so when people send me a Head and Shoulders that's going at an angle, that doesn't work for me. The neckline, in my opinion, needs to be flat. And maybe this was a Head and Shoulders. I really just prefer to look at it in the simpler way and say, you know, we broke out of the trend, we came back and retested, and then we broke out again. That's all I see there. But that's just me. Yeah, thank you, everybody. I appreciate y'all. And I will also say that until Google can hold above that 142, probably not getting long on it. Yep, thank you, everybody. Really appreciate that. But if Google pulls down to this 141, I might try to buy it. You got it, Coinbread. Thank you. Yeah, thanks everybody. Happy you enjoyed it. And as I said, you know, if you got any questions, feel free to you know, always shoot me a DM. And you know, I like to tell people I love looking at charts. So if anybody doesn't know, you know, if you want to take a trade and maybe you're, you know, you aren't too sure about it, uh send me your chart. You know, I'll tell you what I think. You know, maybe we agree, maybe we don't agree. But I can tell you what I see and hopefully help you out, you know. Oh yeah, that was fun in there scalping a little spy end today. Hit a couple of rippers on that thing, man. Man, Dan, did you just call me professional? You must be new here, but I appreciate that. I try to do my best. Thank you. Thank you. Thank you. I appreciate that. I can't I'm posting that on TradeFloor. There we go. Yeah. We like that. Yeah, thank you. I'm happy. I'm happy you think I'm professional. I'm trying my best, you know. I just want to teach people the little bit that I know, you know. I've been doing this for a little while, so I want to share what I've learned and hopefully it can help some other people out, be successful, you know. Okay, well, if that's gonna do it, everybody, appreciate y'all for coming and we will catch you tomorrow. Well, always feel free to shoot me a message, Dan. That's, you know, that's what I'm here for. I actually do remember now that I think about the day you joined, I told you be careful who you take advice from. So that's still the same advice, you know. Okay, right on, everybody. Thank you so much. Hope you all enjoyed it, and we will see you tomorrow, Friday. Trade safe. Thank you.